Well, thank you, Thomas, for those very kind words. It's a lecture very unlike any lecture I've ever given. It's filled with emotions, with intellectual indebtedness, and with very fond memories, so it's really an amazing experience, I must say. Economists have long extolled the virtues of markets. Unfair competition protects consumers from political whims and forces producers to deliver products and services at cost. Alas, competition is rarely perfect. Markets fail, and market power, the firm's ability to raise price above cost or to offer low quality, must be kept in check. Industrial organization studies the exercise and control of market power. To this purpose, it builds models that capture the essence of the situation. The predictions of the model can then be tested econometrically and possibly in the lab. In the end, the reasonableness of and robustness to modeling assumptions and the quality of empirical fit determine how confident we are in making recommendations to policymakers for interventions and to companies for the design of their business model. Industrial organization has a long tradition, first theoretical with the work of French engineer economists Augustin Cournot and Jules Dupuy, then policy-oriented with the enactment of the Sherman Act in 1890, and subsequently legislation, then descriptive with the studies of the Harvard School, structure, conduct, performance, comforting and refining the antitrust drive, and finally skeptical with the Chicago School. The Chicago School correctly pointed out that there was no underlying theoretical doctrine, and it went on to cast doubt on the whole edifice. It, however, didn't develop an alternative antitrust doctrine, perhaps because it was broadly suspicious of regulation. By the late 70s and early 80s, the antitrust and regulation doctrine was in shambles and had to be rebuilt. The modern intellectual corpus that then emerged has been very much a collective effort, involving not only me, but also my closest collaborators on the topic, chronologically and very unfairly to the others, Drew Fudenberg, Eric Maskin, Jean-Jacques Lafont, to whose memories this lecture is dedicated, Patrick Ray, Jean-Charles Rocher, Paul Josko, and Josh Lerner. And the many, many scholars whose own work, discussion with me, and comments on my articles and books have deeply influenced my thinking. My being under the spotlight today owes more to their contribution than to my own talent. But I claim credit for having been in the right places at the right time, and in having learned from fabulous colleagues and students, in the area for which a prize was awarded, and in other fields as well. With sometimes a bit of luck, as when my MIT fellow classmate, and like me, Eric Maskin advisee, Drew Fudenberg, told me about an interesting field. I didn't even know what industrial organization meant. At that time, I'd already passed my generals, but then I decided to sit in fascinating lectures given by Paul Josko and Dick Schmanzi, and I started fruitful collaborations with Drew. A stroke of good fortune indeed, as the required tools, game theory and information economics, were witnessing a series of breakthroughs. On the policy front, there was widespread recognition that all-style public utility regulation led to inflated cost and to poor customer satisfaction, so reforms were called for. To crown it all, institutional change favored the use of economic reasoning. Where disputes were settled and regulation designed opaquely in the minister's office, transparent processes run by independent agencies were put in place. For instance, competition authorities and regulatory agencies sprang up in Europe which use economic reasoning. This most fortunate conjunction of circumstances led to a new paradigm. As was emphasized by the Price Committee's scientific background report, this paradigm is rich and complex. First, counting the number of firms or their market shares provides only a very rough indication of whether the market is competitive. Second, is industries have their specificities. Competition in information technologies, payment cards, innovation or cement is different. Economists, accordingly, have advocated a case-by-case or rule of reason approach to antitrust, away from rigid per se rules, which mechanically either allow or prohibit certain behaviors. The economist's message, however, comes with a social responsibility. First, economists must offer a rigorous analysis of how markets work, taking into account the specificities of particular industries, what regulators do and do not know. This latter point calls for information-light policies, that is, policies that do not require information that is unlikely to be held by regulators. Second, economists must participate in the policy debate. The financial crisis, whose main ingredients could be found in academic journals before the crisis, is a case in point. But of course, here, the responsibility goes both ways. Policymakers and the media must also be willing to listen to economists. Regulators affect industries in multiple ways. Sectoral regulators in telecoms, electricity, railroads, or postal services regulate incumbent operators' rate of return and monitor the conditions under which they give access to their bottlenecks or to the bottlenecks that they control. Antitrust authorities allow or invalidate horizontal as well as vertical mergers and agreements, and decide whether certain behaviors and contractual covenants constitute an abuse of dominant position. Patent and trademark offices and courts grant, uphold, or reject a patent, determine its scope, its breadth, whether the grantee can seek injunctions, and so forth. Ultimately, these various forms of regulation have in common that regulators face a trade-off between lowering the price for the users, thereby ensuring wider diffusion, and granting a fair rate of return to the firm. Consider, for example, the foreclosure doctrine in its modern form. An upstream firm, you, has a unique access to an essential facility, infrastructure, or bottleneck input. Some inputs that cannot be reproduced at a low cost. A railroad tracks and stations network, a power transmission grid, a key patent. The issue is whether the upstream firm should give an equal access to all downstream suppliers, alternative train operators, power producers, technology implementers, which I call D1, DK, DN in the figure. Such fair access allows downstream firms to compete for the end users on a level playing field. The downstream competition enabled by fair access dissipates the profit that can be extracted from end users. You'll get lower prices. And so, because the upstream profit is capped by this downstream profit, fair access jeopardizes the ability of the upstream firm to profit from the essential facility. In practice, therefore, the upstream firm often favors its downstream subsidiary, which I call D1 in the figure, in a myriad of ways. For example, by refusing to deal with rivals or grant them a license, by charging prohibitive access prices, or by making its technology incompatible with that of the rivals. If not vertically integrated, it may enter a sweet deal with a downstream firm to the same effect. In short, the upstream firm uses exclusivity to restore its market power. For example, a biotech company with a patent on a new drug will grant exclusive right for the product approval, production, and marketing stages to a single pharmaceutical firm, either in-house, for example, Sanofi for Genzyme, or external. So whether the antitrust authority tolerates such exclusionary behavior or not, de facto regulates the rate of return on the upstream infrastructure, the essential facility. Now, the question is, should the authority clamp down on such exclusionary behavior? The common sense answer to this question hinges on that to the following question. Does the bottleneck result from an investment, an innovation? Or else does it result from political connections, wrong market design, or sheer luck? Simply, is there an investment worth of a reward or not? For instance, the beneficiary of a highway, harbor, or airport concession deserves its monopoly power if the monopoly position was acquired through a competitive, well-designed auction, but not if it was acquired free of charge or through a biased auction design. An inventor should be allowed to exploit the innovation himself or grant an exclusive license if the innovation is major, but not if the innovation lacks novelty or is obvious, but nonetheless is protected by intellectual property law. A utility should earn reasonable profit on investment, but not benefit from lucky cost and demand conditions. The same reasoning underlies much of antitrust doctrine, which, following Schumpeter, doesn't condone the existence of monopoly power, but frowns upon the further acquisition of market power through merger or abuse of dominant position. Regulators face a double asymmetry of information called adverse selection and moral hazard, respectively. First, regulators have superior knowledge, regulated firms have superior knowledge about their environment, their technology, the cost of their inputs, the demand for their products and services. Second, they take actions that affect cost and demand, human resource management, strategic choice of plant capacity, R&D and brand image, quality control, risk management, and so forth. Unsurprisingly, authorities that neglect the asymmetry of information fail to deliver effective, cost-efficient regulation. There are two broad principles here. The first is obvious. Authorities should attempt at reducing the asymmetry of information by collecting data, of course, by benchmarking the firm's performance to that of similar firms operating in different markets. And finally, by auctioning off the monopoly rights, because in an auction, firms reveal information about industry costs when competing with each other. The second principle is that one size doesn't fit all. One should let the regulated firm make use of its information. But before we get to this, imagine that you are in charge of dealing with a contractor. Two familiar contracts will probably come to your mind. You can offer to fully reimburse the contractor's cost plus some set payment over this cost. Such a contract is called a cost plus or rate of return regulation. Or you can fix the total payment and tell the firm that this payment will cover its return as well as its cost, whatever the latter turns out to be. Such a contract is called a fixed price or a price cap contract. The two contracts differ in the strength of their incentives, which are provided to the contractor. The cost-plus contract shelters the firms from fluctuations in its cost performance. It's completely insured. The fixed-price contract, by contrast, makes the firm fully accountable for its cost performance. So the fixed-price contract obviously elicits more cost-reducing effort from the firm. It, however, has the drawback of leaving substantial profit to the firm in lucky circumstances in which costs turn out to be particularly low or demand high, independently of any effort made by the firm. Returning to the one-size-doesn't-fit-all idea, one can show that the regulated firms should be confronted with a menu of options. To oversimplify, this menu might take the form of a choice between a fixed price and a cost-plus contract. Then the firm self-selects. An efficient firm will opt for the fixed price contract because it wants to be made accountable for its cost. It knows that its cost will be low. While an inefficient firm will opt for the protection of cost-plus, of reimbursed cost. Powerful incentives have been key to remedy the dismal cost performance of traditional regulation. However, theory and practice offer some caveats. First, making the firm accountable for its cost performance also provides the firm with an incentive to scheme quality. So powerful incentive must go together with a more thorough monitoring of quality. Second, the observation that powerful incentives generate both a high effort and high profit or rent implies that regulators cannot have their cake and eat it too. While the regulators, under the pressure of public opinion, may be tempted to take back this rent, those profit exposed, such policy reversal destroys the firm's incentives to reduce cost. A wider knowledge of this principle would have prevented some wishful thinking when powerful incentives were introduced. Thus, powerful incentives require commitment. This commitment in terms requires an independent regulatory agency, protected from the pressure of public opinion. Third, the possibility of high rents increases the benefit for the firm of capturing its regulator. So if you cannot guarantee the regulator's independence from the industry, don't go for high-powered incentives. The essence of regulation is often to ensure that undeserved market power doesn't translate into high overall prices. Traditionally so, regulators have gone way beyond this price level regulation. They have also mingled with a ratio of prices, that is, with a price structure. There too, they face a substantial informational handicap. Moreover, the need for intervention is much less obvious than in the case of the price level. While it is clear that the monopoly has incentive to charge higher prices, very high prices, it is a priori less clear that it is biased in its choice of letting Bob, rather than Anna, bear the brunt of market power. In 1956, Marcel Boiteux, building on earlier work by Frank Ramsey, showed that regulated firms should exhibit a price structure similar to ordinary unregulated ones. The price PI in segment I should be low if the segment is cheap to serve, so the cost CI is low, the cost of serving this segment is low, and the elasticity of demand, eta is high, that is, if a price increase implies a substantial reduction in demand. Thus, regulated firms' prices should be business-oriented. They are very similar to, but overall lower than the price of an unregulated monopoly. The theta in this formula is less than 1. So you reduce the prices without completely changing the price structure. Yet, regulators used to force regulated firms to set economically very inefficient price structures. This price tinkering away from Ramsey-Boiteux principles was motivated by the correct premise that regulators do not possess the information about cost and demand to fine-tune prices in a business-oriented fashion. This reasoning, however, ignores the possibility of making use of decentralized information. A global price cap regulation in which a firm must only comply with some cap on its weighted average price not only create powerful incentives for the firm by making it accountable for its cost, but also lets the firm free to choose its price structure in a business-oriented fashion. A special case of this idea arises when one of the products supplied by the monopoly is an intermediate input. that is the provision of access for rivals to an essential facility. So we'll come back to the foreclosure doctrine. By imposing access prices at marginal cost, assuming they can measure it, regulators de facto bias the price structure and focus markups entirely on those segments, those final segments, for which the essential facility owner faces no competition. This is bound to be very inefficient. A particularly interesting choice of price structure arises in so-called two-sided markets. Two-sided platforms bring together multiple user communities that want to interact with each other. Gamers and game developers for video games, users of operating system and apps developers for operating systems, eyeballs and advertisers for search and media platforms, cardholders and merchants for payment card transactions. The challenge for those two-sided platforms is to find a viable business model that gets both sides on board. Regardless of their market power, whether they are Google or free newspaper like Metro, they choose to allocate a lower burden to the side, say side I in this formula, whose presence benefits most users on the other side. In this equation, Vj represents how much a side j user values an extra user on side I. This willingness to pay for an interaction with an extra user on side I can be recouped by the platform through a price increase on side j. So if you bring an extra user on side I, the users on side j will have an increased surplus that you can recoup through an increase in price on side j. The platform's real or opportunity cost is therefore the platform's production cost C per interaction, which can be zero in practice, it's often zero, minus Vj. Platforms also, like ordinary businesses, choose a lower burden for the side, which has a relatively high elasticity of demand, eta in this formula. This formula very often results in very skewed pricing patterns, with one side paying nothing, a free search engine, free portal, free newspaper, or even being paid to enjoy the service, as when you are a cardholder and you get frequent flyer miles or cashback bonuses for using your card, while the other side is heavily taxed. A regulator failing to understand the nature of two-sided markets might misleadingly complain about predation on the low price side, or even excessive pricing on the high price side, despite the fact that such pricing structure and patterns are actually practiced even by small entering firms. Regulators should refrain from mechanically applying standard antitrust IDs where they do not belong. This doesn't mean that regulators should turn a blind eye when facing two-sided markets. A case in point is provided by platforms that supply a service to their members, but are not the only route for a purchase. For instance, American Express provides a cardholder with a service, but other payment methods like cash, check, other cards are also available, so there are other routes for a purchase. A hotel or airline flight can be booked either through an online booking platform like booking.com or directly. Such platforms usually charge a merchant fee and demand price coherence. Price coherence means that the merchant is not allowed to charge more for a transaction performed through the platform than for a transaction that doesn't use it. While price coherence has sound theoretical justifications, because it prevents surcharging holdups by the merchant, it also comes with hazards. For high merchant fees are in part passed through to third parties, namely the consumers who do not use the platform. So those consumers who do not use the platform are actually going to pay more for their purchase because part of the merchant fee charged by the platform will be passed through by the merchant to consumers. This may result in excessive merchant fees. The market failure in this instance is not the skewed pricing pattern, which is very typical of two-sided markets, but the externality on the non-contracting parties who do not use the platform. The analysis reveals that the merchant fee should obey the following Pigovian principle. In the case of card payments, the merchant fee should be equal to the benefit that the merchant derives from a card payment. The consumer who decides on the payment method, whether to use a card or use cash or checks, then exerts no externality on the merchant because the merchant pays exactly his benefit from card payments. This very simple Pigovian principle is now the European Commission's doctrine for regulating open system Visa and MasterCard. In this realm, as in many others, neither laissez-faire nor shotgun regulatory approach is warranted. Only sound economic analysis will do. The rule of reason approach to competition policy requires some confidence as to which of efficiency and anti-competitive effects dominates. In this respect, simple rules can greatly strengthen our confidence in policy choices. Consider intellectual property, for which a shortage of data can be acute, with technologies not having yet hit the ground. Biotech and software technologies are often covered by a multiplicity of patents of varying importance and owned by different owners. This patent thicket is conducive to royalty stacking, or in the jargon of economists, multiple marginalizations. To understand royalty stacking, which was brilliantly formalized in 1838 by Augustin Cournot, and more recently by Carl Shapiro, it may be useful to return to medieval Europe, whose river transit was hampered by a multiplicity of tolls. For example, there were 64 tolls on the Rhine River in the 14th century. Each toll collector set its toll to maximize revenue, oblivious of what this meant, not only for the users who were paying a high price, but also for the other toll collectors who suffer from very low traffic. Europe had to wait until the Congress of Vienna in 1815 and subsequent legislation to set the removal of toll stacking. High technologies are currently witnessing an evolution similar to river traffic in the 19th century. New guidelines have been set so as to encourage the co-marketing of intellectual property through patent pools. Patent pools are organizations through which owners of patents get together to co-market their patents, their licenses. Patent pools reduce the overall price of licensing complementary patents, benefiting both technology users, but also intellectual property owners. Alas, patent pools and more generally co-marketing arrangement may also allow firms to raise price. For example, the owners of two substitute patents, like the two toll collectors in the two branches of the river here, can raise licensing price by forming a patent pool, setting a collective toll for the downstream access in a figure. It's very akin to a cartel or a merger to monopoly. Instead of lowering the price, it's going to raise the price to the user. A flashback is useful again. A little known fact is that prior to 1945, most major industries were run by patent pools. Actually, when I grew up and studying industrial organization, I didn't know the word patent pool. And the reason for that is a decision by the US Supreme Court in 1945. The worry about cartelization led, through joint marketing, led to an hostile decision of the US Supreme Court in 1945 and the disappearance of pools until the recent revival of interest. But could not competition authorities just ban bad price increasing pool and allow good price decreasing pools? They unfortunately do not possess the relevant information. There is often no long history of licensing, and the pattern of substitutability or complementarity changes with the uses that are made of the technology. Simple regulation, however, allows such sorting. First, individual licensing, the ability for individual owners to keep licensing their patent outside the pool, recreates competition when patent pools will otherwise have raised price. Patent pools with individual licensing therefore neutralize bad pools by allowing good ones to achieve their price reduction. So here you see the owners of patent 1 and patent 2 form a pool, co-market their licenses, but also free to compete with the pool because they keep ownership of their patent, and therefore, if it's a collusive arrangement, if the patents are rather substitute, they can compete with the pool. Second, and to counter the threat of tacit collusion, it is wise to append a second information-free requirement called unbundling. Under unbundling, the users can buy individual licenses from the pool, and not only the bundle itself, and the pool price for multiple licenses is the sum of the individual prices. Interestingly, both precepts, individual licensing and unbundling, derived from theory, have been incorporated in the European guidelines in 2004 and 2014, respectively. Another information-free precept for the treatment of intellectual property originating from theoretical work is a suggestion that intellectual property owners commit to a cap on their licensing price before a standard is finalized. So we need standards because there are network externalities. The various actors in the industry must interoperate. But the issue with a standard is that it may create monopolies. When a standard is designed, in many cases, there are multiple routes to solving a given technological problem. Each one of these routes may be equally viable, but often a standard setting body will choose only one avenue. To pursue the analogy, the public authority may have enabled traffic on the upper branch of the river by installing or building a lock on that branch. Or maybe the presence of a major city on the upper branch may have made this branch a superior alternative, so that actually this branch, which was an equally viable route, actually is no longer a viable one. Once a standard setting decision has been made, however, the chosen patent becomes what's called a standard essential patent. Because the users have to use that patent, then it can ask for a monopoly price. And the patent owner therefore can ask for high royalty, even so another patent could have offered comparable value had the technology been designed differently. To restrain firms from taking advantage of the fortuitous essentiality of their patents, and essentialities that resulted only from being included in a standard, standard setting bodies commonly require firms to commit in advance to license their patent on fair, reasonable, and non-discriminatory terms, what's called FRAND. The problem with this approach is that friend commitments are very ambiguous. What is exactly a fair and reasonable rate? And in fact, large lawsuits involving the major actors in the industry regarding the meaning of the commitment proliferate all over the world. You will not build a house on a piece of land without knowing at what price you'll be able to buy the land. The same obtains for technologies. We economists have proposed that intellectual property owners commit to their licensing conditions prior to the choice of standard. Or those toll collectors should be basically commit to maximum price before one branch is chosen to install a lock. So we try to explain also why this commitment hasn't showed up yet, or very little, and why the standard setting organization haven't required a commitment to a licensing price before the standard is set. And again, we have to think about how we should be using regulation to do that. Theory of industrial organization has proved a major tool to think about one of the major challenges of our economies. It has fashioned antitrust and regulation. Recognizing that industries are different from each other, and so one size doesn't fit all, it has patiently built a body of knowledge that has helped regulators to better understand market power and the effects of policy interventions and firms to formulate their strategies. Industrial organization has gone a long way, but much work remains to be done. An especially gratifying aspect is that the field of industrial organization is currently thriving, with many young top researchers producing exciting work. Making this world a better world is the economist's first mission. I believe that the entire community of industrial organization researchers has contributed substantially to this mission. On behalf of this community, I'm humble, honored, and grateful to be awarded the 2014 Sveriges Riksbank Prize in Economic Science in memory of Alfred Nobel. Thank you.